Sell now. Take your profits off the table before it's too late. In this episode, I'm going to address beware of a false sense of security with money in the market when it's doing well, because it's not going to last. So my name's Doug Andrew, and I've been a financial strategist for more than 48 years. I started in 1974, and I've seen America go through all kinds of gyrations in the market. And oftentimes we go up and down on a daily basis. On a monthly graph, it's a monthly basis. And the market will climb, and then it usually does what? It corrects or crashes. How often? Probably about every 3 to 7 years, which means in every 10-year period, every decade, there's generally going to be about 7 up years. 7 years the market is up compared to 3 years where the market is down. You lost money. Now, in the decade from 2000 to 2010, there was only 5 up years and 5 down years, and 2 of those down years were 40% drops. That's why we call it the Great Recession, or the worst decade since the Great Depression. So we're in volatile times. So my advice in this episode, as you're going to see, is many times I notice people get very complacent. Oh, all's well. And they just see the market is growing. As of the recording of this episode, as I was driving to the studio, they're announcing, oh, the Dow Jones, the market is up again for the second day in a row. This is incredible. It's awesome. And I'm sitting there rolling my eyes on the freeway. Oh, hello. You better take your profits off the table. Don't think everything's fine, because those people end up kicking themselves because they wait, trying to hit this high water mark or recover maybe what they lost a year ago or whatever. And they're trying to get the high. You know who is selling when the market is up? Big, institutional, smart, savvy investors. The general public, they hang in there, and they wait until the market goes down 20, 25. They get nervous, they get anxious. When it hits about 30%, most people in America go, enough already. If it drops 35 or 40%, most of Americans say, I want out. They tell their broker, I want out. And they sell low. Guess who's buying their stocks? Okay, the institutional investors. They buy low. Okay, they sell high. Most Americans do the opposite because they get involved emotionally instead of logically. So let me sort of explain how all this works and what you can do to protect yourself. So as I just indicated, unfortunately, most Americans, they're buying and selling at the wrong times. In fact, Dalbar, who studies investor behavior, says that the average retiree who has money in IRAs or 401ks in the market only averages 3.49% on their money. Now, you'll hear a lot of advisors, asset managers that say, well, our clients average 9%. Yeah, Dalbar says if you left your money in the market and didn't get involved emotionally, and you rode through the ups and downs, you would likely average 9.14%. So let's say that you had $1 million nest egg and you were retiring. And let's say if you left it in there, it earned 9%, you theoretically could pull out 90 grand a year, right? But you got to pay tax on that if it's a tax-deferred IRA or 401k. You pull out $90,000, you pay tax between federal and state tax, usually 33%. It's going to be even higher than that, it sounds like, under Biden's tax proposals. But let's just use a third. You pay $30,000 in tax and you net $60,000 a year, $5,000 a month to buy gas and groceries, prescriptions, and golf green fees. Okay. Now, people might say, ooh, I think we can make it on that until inflation doubles the cost of living every 6 to 10 years, which is where we're headed. And all of a sudden, in 6 years from today, you need 100,000 to buy what 50,000 used to buy. Does that make sense? Because the cost of living has doubled, the purchasing power has been cut in half. This is what causes most retirees to outlive their money. So when I look at retirees, what really gobbles up a lot of their income, or what causes them to outlive their money as they have to take out more and more as inflation causes the cost of living to go up, taxes take out a third or more. People go, oh, okay, well, I'm going to have to have my money, I'm going to have to try to make it up in the stock market. And they take unnecessary risks. Well, Dalbar says that if you bought and held, you should average 9. But if you're only netting 6 after paying tax, that's not going to cut it, was the first point. But in actuality, most people don't buy and hold. As I said, they get nervous when the market starts to go down. They get nervous when it hits about 20% drop, 25, 30, and they go, enough already. If the market drops 35 or 40, which it did twice in the decade from 2000 to 2010, people said, sell, sell. And they're selling low. They wait until the market comes back, and they finally have confidence and they buy high. So that's why Dalbar says the actual investor in the market is only earning 3.49%. That's pretty pathetic. On $1 million, that's only $35,000. That's why the financial services industry came out with what is called the 4% rule. See, if you pull out 4%, you're going to slowly deplete your nest egg if it's only earning 3.5%, but probably not before your LE. LE is your life expectancy. So they tell the brokerage firms, don't let any of your advisors ever illustrate more than a 4% payout. That's called the 4% rule. Otherwise, you've got to get the client to sign a waiver that they will not sue the advisor or the firm for outliving their money. Wow, that's pretty sad. I don't accumulate $1 million nest egg to have a measly $40,000 a year of income, a little over $3,000 a month, and then have to pay tax on it. I know how to earn at least 8% to 10% tax-free. See, let's just take the average of 9. On $1 million nest egg, I can pull out $90,000 tax-free instead of pulling out 4%, $40,000, paying tax of $10,000 and netting $30,000. How much more is $90,000 a year of income versus $30,000? Don't say 60. It's 300% more. Now, if this is intriguing you, let me invite you to subscribe to this channel. Here's how you do it. Click on the subscribe below and click the little bell. Then you'll be notified every time I post a new video like this, which I do almost on a daily basis. And if you can't tell, I'm passionate about educating people like you, giving you insights into opportunities you never knew existed. You can click like, post a comment, share with somebody who you think ought to hear this information. But at the end of this episode, I'm going to show you how you can claim your free copy of my most recent best-selling book. It's called The Laser Fund: How to Diversify and Create the Foundation for a Tax-Free Retirement, and how you can participate when the market goes up, but not lose when the market goes down. So let me touch on that one next, and then I'll show you how you can claim your free copy of the book. So what I have recommended for thousands of people, and I get thank you notes all the time when they implemented this idea, is to use my favorite vehicle, which I call the Laser Fund. Now, LASER is an acronym that stands for Liquid Assets Safely Earning Returns. I want my money to be liquid, to be able to access it when I need it all throughout my lifetime. I want it to be safe, not only in a safe institution, but I want safety of principle, so that anytime I set aside money, I don't want to jeopardize or lose that. And any year that I make money, I want that to become newly protected principal. Meaning, we've had many people on their laser funds this year earn 25%, 32%, 61%. That means if next year, if the market crashed 40%, they would not lose one dime of the money they made this year. It's locked in every year. And then to earn predictable rates of return, they don't have to be pie in the sky, but they're tax-free. And if they're tax-free, a tax-free return of 8 would be like earning a taxable return or a tax-deferred return of 12. If I earn 10, I'd have to be earning 15 or more in the market. And I don't want to try to earn 15. That's very hard to do. So it's called the Laser Fund. And in the book I want to gift you, you'll learn how you can accumulate your money tax-free. You can access that money tax-free. And when you die, it blossoms and transfers tax-free, whatever's left behind. But the most important strategy there that most advisors don't understand is indexing. They think that I'm talking about index mutual funds. No. Indexing means your money is safe. And if you link to an index anytime you feel bullish about America, the insurance company that is paying you 4, 5, 6, or 7%, whatever the general account portfolio is, you're relinquishing the interest, but your million or whatever you have in there is safe. And they take the interest and they buy upside options in the index or indices you chose, the S&P 500 or the Dow Jones. Then they have the wherewithal, if the market goes up, to pay you 12, 15, 32%, 61%. But guess what? If the market crashes, which it's going to do, you don't lose. You still have what you started with that year. You may relinquish the interest if you chose to do that. By using indexing, you never lose money due to market volatility, but you get to participate when the market goes up. Sound too good to be true? It isn't. You can learn about how you can employ this strategy that is used by the wealthy. So here's how you can claim your free copy of this book. Go to laserfund.com, L-A-S-E-R fund.com. Click on the link below. This retails for $20. I will pay for the book. You contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that. And I'll fire out a hard copy to you. It's 300 pages, actually 2 books in one. This side is 200 pages with all kinds of charts and graphs if you're a left brain learner. If you're a right brain learner, you flip it over. This is 100 pages, 12 chapters with 62 actual client stories. If you want to use both right brain and left brain, your whole brain, you can read both books, okay? But you'll see that I'm passionate about educating people like you, giving you insights into opportunities you never knew existed before. And there's options there to listen and learn, watch and learn. And also you'll be notified if we teach educational webinars, and those are free, because I want to educate you, because this is about your brighter future. So beware of any false sense of security if your money's in the market and the market happens to be up, because it's not going to stay that way forever. Take your profits off the table. Do what institutional investors do, and then you won't be kicking yourself when you stayed in the market and watched it go down, down, down until you said enough already. Wouldn't it be nice to not lose when the market goes down and start making money again instantly when the market turns around, instead of waiting to make the money back you lost before you start making money again? That's the power of indexing.